Hey everybody, I want to apologize in advance. Recorded the podcast and had clicked the wrong button, so the audio is not that great in this podcast, but just bear with it and a little bit of background noise. But we'll clean it up for the next podcast. Thanks a lot. Hey, welcome to the podcast, everybody. Happy New Year to you. It's been a while since we've done the last podcast with the holidays and just end of the year and beginning of the year items that come up. And honestly, there hasn't been a whole lot going on with the market. So, but here we are in a new year, and we're already starting to see some different things in 2014 than we saw in 2013. So let's first start out. For those of you that are new, welcome to the podcast. Thank you for joining me. If you want to send your questions to me, it's Karl, Karl, at eggerscapital.com, EGGERSS capital with an A.com. And we will answer those either on a future podcast, or I'll just email you right back if it's something that isn't podcast worthy. And don't take that the wrong way, but if it's something that just doesn't, if it's very specific to you, then of course we could just answer it. But if it's a nice general question, then we'll do it on a podcast. And by the time you watch this, I doubt you'll be watching this at the same time the national championship is on, but perhaps you will. Speaking of college football, here's a picture of me with the Oregon Duck at the Valero Alamo Bowl, and you can't get better seats than that. You can see right there on the field, so pretty cool. I know some of you, at least one of you, I know one of you saw me down there. You know who you are. But anyways, let's get back to the stock market. So the S&P 500 had been in this trend or this channel for most of 2013. And just in late October, we broke out above that. And we started making higher lows, higher highs, just a higher, stronger market. So now here we are coming to the new year, and it appears that this thing is drifting towards the old breakout level. Now it could stop at this blue line, which is a 50-day moving average, somewhere in here. And of course, a really strong drop that would freak everybody out would be to come back into that channel. And here, this is the worst start to a stock market year, or any year, I guess, since 2005. So there's a lot of people kind of freaking out about it. But don't forget how we ended last year, very strong. And it's not uncommon for the stock market, as it's having a strong year, to kind of finish on a strong foot. And that's what it did. And now what we're seeing is, the things that performed the best last year seem to be performing the worst this year. If you take a look at what's working this year, gold is up 3% so far in 2014. Treasuries are up about 0.75%. TIPS, Treasury Inflation Protected Securities, those are up about 0.6%. And then you go to the other side of the ledger, and of course you have oil has fallen quite a bit, down over 4%. I think the NASDAQ, the Russell 2000 down about 1.5%, and the S&P down about 1%, as the Dow Jones down about 1%. But again, what's going on underneath the surface? And so far, it looks like run-of-the-mill profit taking. In fact, one thing that happens at the end of each year, as the calendar changes into a new year, is you do get this. I guess we'll call it jockeying for position, where at the end of one year, the things that ran up last year, a lot of mutual funds want to show that they owned the winners. So everybody sells gold, sells, municipal bonds, sells international stocks, all the things that lost money last year. And they buy all the things that are winning, like the U.S. stock market. And that happens at the end of the year. There are also those, because they want to show that they own those. But there's also those people who want to delay the taxes on stocks until the new year. So they hold off on locking in gains. So, a lot of stocks that ran up last year are selling off this year. Not a big surprise. They're going in there, they're locking in profits. Because again, if you sell something January 2nd, 3rd, 6th, of this year, you don't pay taxes until April of 2015, as opposed to paying them on April of 14 had you sold them just a few days ago. So you have some of that going on where the losers are the winners and the winners are the losers. But, and that'll shake out over the next few days and weeks. As most of you know who've been listening to me for a while, I'm not a huge seasonal guy. I don't believe that, every October it does this or every January it does that. Because again, if you fall into that trap, what happens? You start buying and selling based on that. And the one time you do it, it could be the complete opposite. So you may say, well, the first 3 days are the worst since 2005. I'm going to sell. The last time we had 3 down days at the beginning of the year, I think was 2008. So that was a bad year. So I'm going to sell only to see it run back up. So let the dust settle for the next few days. And I think what you'll see is some stabilization. We got a weaker than expected economic report. And somebody has pointed out that it seemed like each year we get stronger reports going into the end of the year and then weaker reports at the beginning of the year. So we'll see. Again, that's why you use these moving averages. You kind of slow things down. But overall, as you can see right now, the stock market is simply, headed back up, went back down, went to a new high, could come back down here, and then we could go higher. There's no signs of deterioration yet. We do have to understand that this is not a fresh, new bull market, right? This is an aging, old bull market. We did not have 10% correction in 2013. Highly unlikely. In fact, I put this on my client newsletter last month. One of the things that you see on average, you see a 14% drop intra-year. On average. We didn't even get a 10%. So do not be surprised at some point if we do get a correction. It's going to happen. And when it happens, you're going to see people start to panic. But if you look at what happened today, the volatility index actually was down on the day. It actually fell, which is unusual because a lot of people would have assumed that, with the Dow Jones down 45 points, surely the volatility index would have spiked up, and it didn't. It actually fell a little bit. So I want to take you real quick. I don't even think it's worth going through some of the different sectors right now. You have been hearing about some talk of inflation. That's one of my things to watch this year. The market is starting to price in a little bit of inflation based on different spreads we watch, looking at the tips market, looking at the bond market, looking at commodities. And so that's something we want to watch this year to see if inflation becomes a problem that people start to price in. Because when it happens, not that inflation will take off necessarily very quickly, but the investments that benefit from inflation will start to do very well very quickly. So again, keep that in mind because a lot of those things were on sale last year, and they could be the big winners this year. So we'll have to wait and see on that. But we'll let a few more days and weeks go by before we really get into a lot of the specific sectors. We want to see some of the trends that are developing, and we haven't seen that just yet. But I do want to take you on a brief little history lesson here, and this is something I've been talking about the last couple of weeks. A lot of people believe that we are destined to fall because we just had a nice run, and we've had a nice run since '09, so we're destined to fall. And I want to kind of look at the prior two peaks. The 2001 peak, the 2007, 2008 peak, and then now. What were the characteristics then, and what are they now? Well, in 2000, you remember that we had this raging internet bubble, big, huge bull market where the S&P went from about 450, we'll call it, back in 95, all the way up to 1,500, so it tripled. But what happened during that time was the internet was fairly new as far as everybody using it, and it took stocks up. I mean, the average PE ratio of stocks here was 30. That's twice the long-term average of 15, price divided by the earnings. So people were paying twice as much as they normally do for a dollar of profit. And it wasn't just internet stocks. It took up the Coca-Colas, the Walmarts, all those stocks had PE ratios of 60. It was crazy. And so all these stocks started to fall. So this was, and I won't spend a lot of time on this, but this was a market characterized by multiple expansion. That's what that was. This was people just paying more for stocks. It wasn't about the profits. It was about the appetite for risk. And so when that bubble burst, which was a stock bubble, it took us down quite a bit. But during this time here, there was a lot of places to hide. There was a lot of things during that time that still continued to work. And so you saw a lot of mutual funds do okay. And if you weren't real tech heavy, you did okay. It wasn't horrible. We kind of came back a little bit, and it was pretty boring. I would characterize the 04, 05, 06 time frame similar to what we're going through right now. I think this time frame right here is similar to what we're in the last couple of years, which is a low volatility area. You don't see a bunch of excitement. Yes, there's more news headlines that seem negative, but on the upside, you don't see a lot of excitement. But what happened during that time was we started to see a housing bubble, right? And the government was trying to get everybody into housing. Social experiment. Let's see who everybody can get in there and buy a house. And not everybody should have been a homeowner. There are people that should be renters. There's people that should live in dorm rooms, right? Not everybody should be a homeowner. But that social experiment led to really a credit bubble, and this led to obviously a big financial crisis. During this time, there was no place to hide. Cash and treasuries were the only thing that did well. And if you didn't sell, you got hammered. And so these two time frames that we're looking at, those two time frames are very different. This peak and this peak are very different. In fact, just for comparison, at the peak of 2007, the PE ratio was about 30.7, almost 31, so twice the normal average. And that's what I had said a few minutes ago. But treasuries were paying 6.2%. So you could go earn 6.2% by buying a 10-year treasury. If you fast forward to this time frame, what did it look like then? Well, during that time frame, the PE ratio was only 17.5. So it wasn't that stocks were expensive here. Treasury bonds were paying 4.7, still a reasonable rate. The scary thing was stocks weren't ridiculously overpriced here when we had this nasty fall. So it's a good lesson that don't think that we can't have a fall just because stocks aren't overpriced. Stocks can fall for any reason. But in here, we had more of a credit crunch. We had big, large companies going bankrupt like Lehman Brothers, Chrysler, GM, Washington Mutual, all these forced turnovers or takeovers like Bear Stearns. That was something that this time frame was something we hadn't seen since the Great Depression. So we get this violent sell-off, which is followed by a violent rally. Okay, and here we are now, and everybody's wanting to say, well, we're seeing similar characteristics to here. The answer is we're not. We're not seeing similar characteristics because now what you have is stocks are about the same price now as they were back in 07. However, we have much lower interest rates. So there's not a lot of places for people to go. Do you sell your stocks up here and go to the market and earn zero? Do you sell your stocks and buy, CDs paying 1% for the next few years? Do you sell your stocks and go buy a 10-year treasury bond paying 3 when the Fed's already hinted and said that they are going to slow down their bond purchases, which means that buyer, the bonds, isn't going to be there? Is that what you're going to do? I think the answer is no. But here's the thing that all three of these will always have in characteristic. It's the same characteristic, which is the supply and demand. How much money is flowing into the market? What is the intensity? Is everybody participating in these rallies? Both of these times, 2000 and 2007, we saw a deterioration of the markets back here. There was plenty of deterioration of the markets back here. And that progressed over time. So as the bull market matured, you started to see deterioration where certain sectors weren't participating. In 2007, there's a lot of stocks that had already peaked out and had been in their own private bear market. That had happened. And yet, the stock market continued to make new highs because it was only 500 companies in the S&P 500. It was only 30 companies in the Dow Jones. Now, what you see is we still have a healthy, strong bull market. We're not seeing deterioration like we did back then. So I don't think we're at the start of a bear market. Okay, Are we at the start of a correction? Because that's the second part of this conversation. And the answer is, why not? Why not? Nobody knows when corrections happen because they can happen violently. 2011, do you remember that our debt was downgraded? The stock market fell 22% or so during that time. Very quick and violent, came out of nowhere. Flash crash, about a 17% drop. So for us to drop, for something like that, would not be shocking at all. So my point of this is that you have to look at time frames, and if you're investing, I wouldn't be changing a tremendous amount right now because the medium term, the next several months, look pretty good. The next few days and weeks, we could absolutely get a correction. Perhaps people wanted to be selling their stocks late last year, but said, I'm going to wait until the new year. Maybe it's starting right now. So we could have a correction at any time. What you have to determine is when you look in your portfolio, what things are up for a trade, what things are up as an investment. The things that are for an investment there's nothing triggering those things to sell right now. Does that mean I'm not going to sell something tomorrow? Absolutely not. There are plenty of things that I could sell tomorrow because they're more of a trade. They're not acting the way they should. They're individual positions. You're changing the portfolio. But as far as we're talking about risk on, risk off, risk is still on right now, and I don't think that's going to change for the short term, or excuse me, for the long term. But for the short term, we could see some profit taking for sure, and that profit taking can always escalate, and it can be violent. And so what we really want to see from a longer term perspective is little spikes in fear. That's what we get. That's where we get our buying from, is these little spikes in fear. Now, if we break this red line and we come down again, the next support would be something along these lines, which would be, let's just call it the purple line, which is, let me take this off, the purple line here, which is the 100-day moving average. That would be, right now that's sitting at about 1738. So that's at 90 points off of the S&P, which is at 18. So you're talking about 5% drop. That would be nothing shocking, would it, for us to see a 5% drop? But, and by the way, that's somewhere, as time goes on, this will meet. So this is kind of your potential target zone if we continue to correct, would be somewhere in there. At that time, the market may be down 5%, but you have to start looking at your positions. What would be down 15 or 20%? Which of those stocks would be down 15 or 20%, 30%? There's a lot of stocks that obviously have higher beta, they call it. They move more than the market. How much of those things do you own? But again, the things that you were wanting to get rid of last year and wanting to sell because you just couldn't stand them anymore are the things that may be working this year. And that's where diversification comes into play. So that's basically it. I just want to take you to a quick history lesson. I do not see deterioration in the market yet, but we could be setting ourselves up for correction in the very short term. All right, guys, Happy New Year. Don't forget to check out all the places that we're on: Google+, Facebook, karleggers.com, eggerscapital.com, iTunes. And don't forget to send your questions to Karl at eggerscapital.com as well. We will talk to you soon. Take care.